Mortgage markets are actually very, very important for a couple of different reasons. The first reason is, of course, that housing is generally the largest asset in household portfolios, and mortgages are, generally speaking, the largest liability in household portfolios. So consumer choice is obviously at the heart of mortgage markets, because consumers are indeed, at the end of the day, choosing these mortgages. Choosing mortgages is complicated. They have a huge number of features associated with them. What is the loan-to-value ratio on the mortgage, for example? What interest rate path do you have on the mortgage? Is it a variable rate interest rate that sort of keeps resetting at certain points in time? Or is it, on the other hand, a fixed-rate mortgage product? That's another feature of the product. What is the repayment period over the mortgage lifetime? Is it a 20-year mortgage? Is it a 25-year mortgage? Is it a 30-year mortgage? And then, of course, there's a huge set of other issues that arise, which is how suitable is a particular mortgage for my current financial situation? Do I expect that my income prospects are going to improve over time, in which case I might find it easier to make overpayments on the mortgage, and therefore should I choose a mortgage product that allows me to prepay at some point in the future? So as you can see, there's a bewildering array of issues that confront the average consumer operating in the mortgage market. And this is not just at the point of choosing the mortgage, it's also at the point of maybe refinancing or switching the mortgage to another product. Now, consumers suffer from all kinds of problems when they're making these complicated choices. Behavioral economics has a big role to play, therefore, in thinking about consumer choice in mortgage markets. For example, households might have self-control issues that make it difficult for them to save for the future. That then affects their choice of mortgage product, potentially. Households might find it difficult to make the complex calculations that are required to realize when they have to refinance their mortgage. That's another issue that arises in this context. We are looking at the entire Danish mortgage market because it's a market in which the design features are such that there are very few constraints on households to be able to refinance their mortgages. And what does that mean? It means that if they don't refinance optimally, then it's very likely, not because they're constrained, because the market is very good at removing constraints, but it might be because of the behavioral issues that they face when they're deciding how to optimally refinance the mortgage. We do find that, for example, younger households have a propensity to respond quicker to interest rate stimuli than older households. We find that more highly educated households, generally speaking, tend to respond quicker than less well-educated households. On the other hand, there are also some opportunity costs of responding. So, for example, high-income households or high-wealth households require a larger interest rate stimulus before they actually go out there and respond to interest rate decisions. Actually, if you factor in inertia and inattention, we find that households are leaving a huge amount of money on the table. Two takeaways for policy. The first one is that monetary policymakers can't assume that when they change the interest rate, that refinancing channel is going to make it very easy for them to change consumption outcomes and other outcomes in the economy, because households may be sluggish in the way that they respond. Policy outcome number two is perhaps the creation of products that make it easier for households to do so. Either they get prompted at particular points in time when it's optimal to refinance, or there are automatically refinancing mortgages that get created, or other such products that might be useful for households.